Hello, everybody. Welcome to Elevate Wealth Advisory's first webinar of 2024. I'm Betsy Kenyon. I'm the marketing coordinator at Elevate Wealth Advisory. And some of you are new to us. We are a wealth advising firm in Athens, Georgia. We were founded in 1982 by Chuck Vickery, who is still with us. And he founded the organization with the goal of helping people make smart decisions with their money. It's since been taken over by Deanne Rosso, who we have with us here today. Hi, Deanne.
Hey, Betsy.
Deanne joined the firm in 2008 and then took over as president and CEO. She is a very proud University of Georgia graduate, and she lives right here in Watkinsville, Georgia, with her husband, Brandon, and their 3 boys, who are also Georgia Bulldogs fans. Thank you so much for joining us, and I will go over a few housekeeping items first. So if you all look at the bottom of your screen, you'll see a Q&A box and a chat box. So if you have any questions for Deanne throughout today's presentation, just go ahead and put those in there and we will make sure your question gets answered at the end of our webinar today. And then I'll also be sending you a link to the webinar so that you can share it with all your family and friends. So we're really excited to present to you the 2024 key numbers update, and I'll let Deanne take it from here. Thanks, Deanne.
Awesome. Thanks, Betsy. Hey, everybody. It's nice to be back with you here in 2024. If you can believe we're saying the year 2024, it's amazing. And as Betsy alluded to, every month we like to do these webinars just to put out some educational content, things that we think are really important for our clients and just, the world at large to know. So today's topic is key financial data for 2024. And I'm going to try and take what is some very bland number data and just let you guys know what's important about these numbers for 2024 and what you guys can focus on to make sure that you are doing everything that you can to be as financially successful as possible. I know this time of year, a lot of people make resolutions, and particularly financial resolutions tend to be top of mind with New Year's resolutions. And so sometimes looking through these numbers and thinking about how you can do things a little bit differently that might help your financial situation or your tax situation, that can help you better achieve those resolutions. So what I'm going to do now is I'm going to share my screen with you guys. If I hit the right button, I'm going to share my screen with you guys. And it is the key financial data card for 2024. And I believe Betsy is going to put this in the chat box so that you guys can download it at home and look through it, print a copy for yourselves and or look through it as I'm going through this presentation. But rather than do slides today, I thought what I'd do is just use the data card itself and walk through the different areas that I wanted to make sure that I shared with you guys today. So key financial data 2024. This key financial data really has a lot to do with taxes. And a lot of times as financial advisors, we get the question, like, why do you guys care so much about taxes? You're not tax preparers. What's the big deal? Why do you go, especially for me, my clients are always like, why are you talking to me about taxes all the time? And it's because that's one of the areas where we can, if we pay attention to, if we focus on it, we can help control. So we know there's lots of things in our financial lives that we can't control, but some of the things we can control are the risk we take in our portfolio and the fees and taxes that we pay, and the decisions that we make along when it comes to our financial situation and how we behave appropriately, meaning making sure that we stick with the plan and don't veer off track when the going gets tough. So, but taxes are one of those things that we really have a little bit, at least, control over in our financial lives. And so I really like to talk a lot about taxes. And that's why today I'm doing the key financial data update, because a lot of this has to do with tax brackets and tax rates and the things that you can expect tax-wise this year. Next month, I will be doing another tax planning webinar, so be sure to tune in for that, where I'll go a little bit deeper on some of these tax topics that I'll talk about today. But today is going to be a really high-level overview. And when I look at the key financial data card, I always like to start in the very middle, and I'm kind of circling that on my screen right now: standard deduction and child tax credit. Now, it'd be really easy to start over here on the left on the tax rate schedules, but I like to start with standard deduction for a reason. And that's because when we talk about tax brackets, standard deduction, what this number really means is the amount of income that you can take that the that the IRS just gives you for free. The federal government just gives you for free. This is the amount of money you can make without paying any income tax on it at all. So this is where I like to start. So these numbers have inflated. Almost all the numbers on these cards have inflated over from 2023 into 2024. So this year, if you are married filing jointly, your standard deduction is $29,200. And if you're single or married filing separately, your standard deduction is $14,600. So if you'll remember, quite a few years ago, before the Tax Cuts and Jobs Act was passed, the standard deduction was about half or less than half of this. It was really low, and we had lots of opportunities for miscellaneous deductions. Now, however, most Americans are going to take the standard deduction because it's pretty high. I mean, for a married filing jointly couple to be able to get almost $30,000 of income without paying a dollar in tax on it, that's a pretty high standard deduction. Additional deductions for non-itemizers. So, you either take the standard deduction on your tax return or you itemize, meaning you have enough in other deductions that you can add it up to be more than the standard deduction. But if you are blind or over 65, you can add an additional $1,550 each to your standard deduction. And if you're blind or over 65 and you're unmarried and not a surviving spouse, you can add $1,950 to your standard deduction. So, and that's per person. So that means that for a married filing jointly couple, they get to add $3,100 to the $29,200 for their standard deduction for 2024. So that's why I like to start with standard deduction. It kind of gives you a baseline of, as a married filing jointly couple, I can take $30,000 essentially of income. Or if I'm single, I can take $14,600 worth of income first before I pay any tax. Also in this section, I like to cover child tax credit. If you have if you have children that are under age 17, you get a $2,000 tax credit per child. And it says 1,700 of that is refundable. And just what that means is if you end up owing no tax, you can actually get up to $1,700 of it back. So that's the child tax credit. And that does have an income phase out. So if your income as married filing jointly is $400,000 or more, then that child tax credit phases out. Any other tax filing statuses, then it's $200,000 before that child tax credit phases out. So it's a pretty high income phase out to be able to get that child tax credit. Remember, there are no more personal exemptions. So child tax credit is pretty much it as far as adding on to your standard deduction for extra stuff that you can deduct on your tax return. Okay, so now that we've covered the standard deduction, let's head over to the tax rate schedules for 2024. So as you all know, we are in a marginal tax rate system. And what that means is that we pay a marginal tax rate on the first bracket of dollars, and then that jumps up to the next marginal tax rate on the next dollar of income after that. So these tax rate schedules have increased. They did inflate this year, so we get to take a little bit more income in each tax bracket. So here's what they look like for single and for married filing jointly. Basically, you get to take your standard, and this taxable income, keep in mind that this is after your standard deduction. So if you're single and you're in this $0 to $11,600 taxable income space, what that really means is that you took about $40,000 of income, and your marginal tax rate is 10% in that bracket before it jumps up from 11,601 up to 47,150 in that 12% marginal tax rate space. So again, you only pay the 12% of the amount that's over 11,600 in this bracket. And then with married filing jointly, same concept. For the first 23,200, which is really about $50,000 of income, that keeps you in the 10% tax bracket. And then that jumps up from 23,000 to 94,000 in the 12% tax bracket. And then 94,000 to 201, you're in the 22% tax bracket. So we've got a pretty high amount of income that we can take at pretty favorable tax rates right now. I'll scroll down a bit. There are other tax filing statuses like head of household, married filing separately. Those are used in certain situations. I want to touch on estates and trusts really quickly because estates and trusts have a really low marginal tax rate, or the income levels you can take are pretty low before those tax rates jump up. So to touch on estates and trusts, and those are entities, right? Those are not individuals. So if you have an estate account or if you have a trust account, any income that comes into those types of accounts is taxed every year. And this is what that tax rate schedule looks like. So for the first $3,000, it's at 10%. And then from $3,000 to $11,000, it's at 24% before it jumps up really quickly at $11,000 to a 35% tax rate. And anything over $15,200 is taxed at a 37% tax rate. So personal tax filing statuses, personal tax rates are a lot less than tax rates for estates and trust. And that's just something to keep in mind. All right, heading on over now back to the center of the card, where we'll talk about tax rates on long-term capital gains. And I keep messing up my screen and skipping around on you guys. Let's try to zoom in here so I can show you tax rates on long-term capital gains and qualified dividends. So one of the strategies that we try to help our clients employ is, of course, minimizing income taxes, but also what are the tax rates on different types of assets? And on long-term capital gains and qualified dividends, it's all dependent on your income. So, and we have some pretty favorable rates here. If your taxable income for this year falls below $47,025 for single or $94,000 joint, you pay 0% tax on long-term capital gains and qualified dividends. So this can be a really nice retirement income strategy if you plan that way and you save along the way in normal or individual or joint investment accounts, non-retirement accounts that earn long-term capital gains and dividends. You can take a pretty good amount of income at a 0% tax rate. And then if your income is above $47,000 or $94,000 joint, then that tax rate jumps up to 15%, but that's still really favorable compared to what it would be in your regular tax bracket, in your ordinary income tax bracket. And even at the highest tax rate, if your income falls above $518,000 this year, if you're single, or $583,000, that's almost $600,000 joint income, your long-term capital gains and qualified dividends rate is only 20%. And that is a huge discount compared to what your ordinary income tax rate would be at that level. So it's really nice. I'll talk again in the next webinar a lot more about how we incorporate these type of strategies into income planning. But it's really nice to keep in mind that if you need to take capital gains, what will that rate be? And sometimes utilizing those capital gains to your advantage. The last thing I'll hit on in the center of this card is the 3.8% tax on net investment income. And what this is called the Medicare tax. But essentially, if you're married filing jointly and your modified adjusted gross income, or MAGI, is over $250,000, anything over that is taxed at an additional 3.8%. If you're single and your MAGI is over $200,000, you get that 3.8% tax and that's called the net investment income tax. So just something to be aware of when you prepare your taxes. If there are these other taxes that you're not really sure where that came from, sometimes this is one of those things that people trigger and they don't really like unintentionally. So if you're close to $250,000 of modified adjusted gross income and there's any way you can bring that down so you don't pay that 3.8% tax, that's something to pay attention to. All right, let me zoom back out so we can head on over to the right side of our card. And let's talk for a minute about gift and estate tax exclusions. A question that I get a lot of the time is, how much can I give? How much can I give to friends or family or just individuals without triggering anything I have to do? And the answer to that question is this year's gift tax annual exclusion is $18,000. What that means is any individual can give $18,000 to any other individual without having to report it. And there's no real tax benefit there's no tax benefit to the person making the gift or to the person receiving the gift necessarily. It just means you don't have to file a gift tax return if you keep it under $18,000. But what does it mean if you do give more than $18,000? Then what do you have to do? And that means you have to file a gift tax return. So let's say that I gave my son $20,000 this year. Well, then that would mean that I had $2,000 over the gift tax annual exclusion, and I would need to report that $2,000. And what happens with that $2,000 is it goes against what my lifetime exclusion amount is. And this is really high. This year, this estate, gift, and GST, which is generation skipping tax exclusions, is $13,610,000. So my $2,000 would go against my lifetime exclusion, and that would lower it to $13,608,000. So that's how those two figures work together. But in general, we still are experiencing the really high estate tax exclusion amount. So anyone who is giving away, and also this is per person. So if you're a married couple, then each of you has the $13.6 million that you can give away. And at this point in time, if one of you passes away before the other and one of you doesn't use all of the 13 million, you can carry the remainder of that 13 million over to the surviving spouse so that they can use the rest of what the married couple would have benefited from. So, and then the maximum estate, this is federal estate tax. The maximum federal estate tax, if you are over this exclusion amount, is 40%. This year, for education credits, deductions, and distributions, we've got the American Opportunity Tax Credit, which is a $2,500 tax credit, and the Lifetime Learning Credit, which is a $2,000 credit. There are income phase outs for both of those, but important to know, if you yourself are a student or you have a student in your life, that is a dependent of yours that you file in your tax return, what credits you may be eligible for. Another thing that I like to point out is Coverdell's and 529 plans. Coverdell education savings accounts this year, you can put $2,000 in. That's your maximum. Kind of like IRAs. Actually, a Coverdell is a lot like a Roth IRA for education expenses. So you can put $2,000 in, you can let it grow, and as long as you spend it on qualified education expenses, then the distributions are tax-free. But you're limited to $2,000 a year on that one, and that's been a $2,000 limit for a long time now. Most people now are favoring 529 plans, and that's for two reasons. Number one, they act a lot like the Coverdell in that you can put you're not limited to what you can put in it necessarily. So there are some limits, but they're really high, like $250,000. That would be over a 5-year period. So the limits of what you can put in are really high. But they're also, the funds you deposit in there are allowed to grow, and they're used tax-free if used for education. You can now use 529 plans for K through 12 education. So if you have primary education that you pay for, you can take a $10,000 distribution from that account per year to pay for it. And then there's no limit on the distributions for higher education as long as they are qualified education expenses. Another thing that can be a benefit to the 529 plan is what are state-specific provisions. So I know I would live in the state of Georgia. We're here in Athens, Georgia. And in Georgia, if you utilize the Georgia 529 plan, each person can put in $4,000 per person or $8,000 per married couple per child or beneficiary, and deduct that on your state tax return. So lots of benefits to saving in a 529 plan. Also, with the new Secure Act, this will be the first year that you can begin the 529 plan to Roth IRA conversion. Lots of rules around that, but that is a great provision that in the future will allow us to use unused 529 plan money to roll over to Roth IRAs and then utilize those funds later for retirement. On the card, I won't detail it all out, but if you want to download it or have a copy for yourself, you've got all your tax filing deadlines here, as far as what are your estimated tax deadlines and what are your business tax return deadlines. So that's a handy reference there. Okay, let me zoom back out. I'm going to go on now to the back side of the page, or page 2, and look at a few different things here. So let's talk for a minute about retirement plans. Scroll over and down. One area that a lot of people focus on this time of year is retirement plan contributions. And the reason for that is maybe you got a raise at the end of last year. Maybe you're making those resolutions and you want to save more this year. So these numbers are really handy because this tells you what are the limits that you can put in your retirement plans. So this first one here, annual compensation used to determine contribution for most plans. This doesn't often apply to a ton of people, but if you're a high wage earner, it's important to know that in your defined contribution or defined benefit, like a 401k, a 403b, cash balance, whatnot, $345,000 of income is the maximum that you can use to calculate your retirement plan contributions. So that's an important number for high income earners and or business owners that are trying to truly maximize what they can put in their retirement plan. With a defined contribution plan, and that's a plan like a 401k or a 403b, or you can put up to $69,000 total in a plan. That number, the $69,000, is the combination of what you put in from your salary, what your employer matches you, and also profit sharing. So that's important to know. That's not just salary deferral. And then the defined benefit plan basic limit is $275,000. But one really, really important number to note here is 401k, 403b, 457, Roth 401k plans, elective deferrals. $23,000 is the amount of your salary that you can defer into those types of plans this year. So I'll talk about 401ks because that's the one that most people have, or a 403b, but you could defer up to $23,000 of your salary this year. And if you're over age 50, you get what's called the catch-up contribution, and that's $7,500 on top of the $23,000. So that's $30,500 if you're over age 50 that you could defer from your salary into your 401k plan or your 403b plan this year. One thing to note here on catch-up contributions is under the Secure Act, this year was supposed to roll out the year that for catch-up contributions had to go into a Roth 401k, but that has been delayed so that plan providers have time to catch up administratively to being able to offer that to plans. So this year could potentially be the last year that you could put that catch-up contribution in on a tax-deferred or a pre-tax basis. Simple plans, elective deferral limit. So if you don't have a 401k, 403b, but your employer or you're a business owner and you offer a simple plan, your salary deferral limit is $16,000 and your catch-up is $3,500. So you could get a total of $19,500 in your plan in salary deferral. And keep in mind that these salary deferral numbers do not include your employer match, if they match anything, or any profit sharing contributions that your employer might add. Scrolling on down to IRAs. So this is exciting. IRA contribution limits. Again, under the Secure Act, IRA contribution limits will now inflate with inflation. In the past, that has not been the law. They the IRS would raise contribution limits every now and then, but now the contribution limits will go up systematically with inflation. So this year, if you want to contribute to a traditional IRA, you can put in $7,000 per individual. And if you're over age 50, you can put in an additional $1,000. The difference between these two at the top here, traditional non-deductible and traditional deductible. Well, exactly what it says. One is not deductible on your tax return and one is, but what makes it not deductible? So anyone can contribute to an IRA. If you have a 401k plan, if you have high income, it doesn't matter. If you want to put money in an IRA, you can put money in an IRA up to the limits. However, your income has to be under a certain amount for that contribution to be deductible. If it's not, it's what we call a non-deductible contribution. So looking here at the income limits, if you are covered by a plan at work, then you can you're limited to up to $143,000 of income before you can no longer contribute to a traditional IRA, and up to $87,000 if you're single or head of household. And if one of the spouses is covered by a plan but not the other, then your 230 to 240 is the income limit for married filing jointly in order to be able to contribute to a traditional deductible IRA. Otherwise, if you are covered by a plan and your income is higher than these limits, you can still put in an IRA, but you won't be able to deduct that amount. And then we flip over to the Roth IRA. So with a Roth IRA, we also have income limits. The contribution limits are the same, $7,000 per individual, $1,000 catch up, but you can't do both. So you can't contribute to traditional IRA and a Roth IRA at the $7,000 level each. You can do one or the other or a combination. You can split the amounts, but you are limited to the $7,000 total per individual plus the $1,000 catch up per individual. Roth conversions here, no income limit. What is a Roth conversion? That just means that we put money into a traditional IRA, maybe for a period of years, maybe just one time, I don't know. And we decide that, hey, instead of getting the deduction on that, I want to, or instead of letting that continue to grow tax deferred, I want to move it over to my Roth. And when you move it from a traditional IRA over to your Roth, then it's taxable. But after that, all earnings and everything inside are not taxed again. So it becomes your Roth IRA. So next webinar, again, I know I'm really hitting hard on previewing next month's webinar, but I'll talk more in detail about Roth conversions next month. Another important type of account that I really, really love is a health savings account. A health savings account is, I always describe it as a Roth IRA on steroids, because with a Roth IRA, you put money in without a tax deduction, it grows tax-free, and at retirement, you get to pull it out without taxes. Very basic explanation. With a health savings account, not only do you get to put the money in and it's tax deferred forever, but you get to put the money in tax-free. So you have to have a high deductible health plan that's eligible for an HSA in order to have a health savings account. But the maximum deductible contribution is $4,150 for individuals or $8,300 for families. And you do get an extra $1,000 per person catch up if you're over age 55. So my recommendation typically is, if you are in a high deductible health plan, well, first of all, choose whether or not a high deductible health plan is right for you. And if it is, start a health savings account and try to maximize that, because even if you don't spend those funds, and in fact, I recommend not necessarily spending those funds on your healthcare during the year, but allowing that to be almost like a retirement savings account that grows for you until retirement. And then you have a pool of money that's set aside completely tax-free to pay for some of your healthcare expenses in retirement. So again, another strategy, but it's deductible on the front end as well, which I really, really like. Long-term care premiums. If you have long-term care insurance, part of that premium can be deductible to you, and it depends on your age. So this age bracket here, 40 or less, 41 to 50, 51 to 60, depends on how much your long-term care premium qualifies for a medical expense. So if you're over age 70 and you're still paying long-term care premiums, up to $5,880 of those premiums can be counted as a medical expense. Now, the problem with that is it counts as a medical expense, and you add that up with all of your other medical expenses, and all of your medical expenses have to be over 7.5% of your income before they're eligible to be deducted, and then you have to itemize your deductions. So that's a lot of jargon to say, even though these premiums, you do get expense deduction for some of your premium, you're not always available to use it for, number one, if you don't itemize and you don't have high medical expenses. But still, a good thing to know if you are paying long-term care premiums, so that you can tell your accountant that when you do your return your tax organizer, or when you're gathering all of your tax documentation for the year, so that your accountant knows, so that he or she can input that and see whether or not you're eligible. All right. Let's talk real quick about Social Security. One of the three pillars of retirement income is Social Security. Pop back to that. And Social Security benefits, this one here, estimated maximum monthly benefit of turning full retirement age. So if you're turning full retirement age, which is age 66 in 2024, and you had maximum earnings for 30 years, then the max monthly benefit that you'd be eligible for this year is $3,822. And then this retirement earnings exempt amounts. So there's what's called the earnings test. If you are under your full retirement age, which is either 66 or 67 or 66 in some period of months, depending on your age, then you are you have a limit to how much you can earn in a year if you're getting your Social Security benefit before you have to pay some of that back. So these are your retirement earnings exemption amounts. If you're under full retirement age, you can earn up to $22,320 this year in earned income before you have to give any of your Social Security back. If you are turning your full retirement age this year, you can earn $59,520. But after your full retirement age, you can work as much as you want to, and you can earn as much as you want to, and there's no limit. There's no penalty for earning while claiming your Social Security. And they do that so that people really do wait until they stop working to claim their benefit. But everybody's personal strategy is, very dependent on your situation. Taxes on Social Security benefits. So Social Security benefits are taxed based on your provisional income. And the definition for that is way down here at the bottom of this box by the little asterisk, which is your provisional income is your adjusted gross income, not including your Social Security, plus tax exempt interest, plus half of your Social Security benefit. So basically take your adjusted gross income, add in any tax-free interest that you got, and then add half of your Social Security back. And that gives you your provisional income. And that's what determines how much tax you pay on Social Security. So if you're married filing jointly and your provisional income is under $32,000, then there's no Social Security tax. And a lot of times people are like, well, there's no way you can live under $32,000 married filing jointly and pay no tax on your Social Security. But actually, it just depends on how you have your money positioned in different buckets, how you take that retirement income stream. There are ways that potentially folks could have an entire, very comfortable retirement income and pay no tax on their Social Security. But even then, if your provisional income is over that, 32 to 44 married filing jointly, or 25 to 34 if you're single, then it's only up to 50% taxable. So only half of your benefits taxable. And over 44%, the most, your Social Security at most is only 85% taxable. So they do give you 15% benefit for free, essentially, on your Social Security benefit. And then just really quickly, the tax that's paid on your, the FICA or tax, Social Security tax that you pay on your income. So for those of us who are still working, our employer pays 6.2% and we pay 6.2%. And if you are your employer and your employee, or you're self-employed, you pay 12.4% in Social Security tax. And then here's the maximum tax payable, which is $10,453 for individuals, or if you're self-employed and you pay both parts, $20,906. And that's what goes into the kitty, if you will, for Social Security to pay out benefits. Okay, let's go on. We're approaching the end here. Two more things that I want to talk about really quickly before we wrap up for today. One of those is Medicare premiums. So one thing I didn't mention when I was talking about Social Security is the Social Security Administration gave a 3.2% inflation adjusted increase in benefits this year. Medicare premiums also increased by about 5.4, I think, percent. So Part B premium Again, and premiums are based on your MAGI, that modified adjusted gross income, and they're based on premiums from income from 2 years ago. So if you're looking at if you got a statement of your Social Security benefits this year and your Social Security benefits went down, more than likely it was because your Medicare Part B premiums or Part D went up. Not because your Social Security went down. And that could be because your income 2 years ago was higher than it is going to be this year. So again, 2024 Medicare premiums based on what your 2022 tax return said for your modified adjusted gross income. And if you were single or joint, $103,000 single income or $206,000 joint income or less, your Part B premium this year is $174.70, which is $9 more than it was last year, and you have no Part D adjustment. But as your income rises, we get what's called IRMA, the income-related monthly adjustment amount, and that's where that Part B premium increases. So this is what I'm talking about, where if you got that statement and your Social Security went down, maybe your income was higher 2 years ago, some event happened or whatnot that caused your Medicare Part B premium to jump. And so that only happens for a year. The good thing is if your income goes back down, your premium goes back down. It just catches people off guard sometimes because you forget really what happened 2 years ago and why that premium might go back up. And so the Part B premium would go up, it would have that IRMA, and your Part D, you'd also get an IRMA adjustment for those Part D premiums. And that's what that looks like. And then lastly, before we wrap, the uniform lifetime table. I get a lot of questions about required minimum distributions, and that's what the uniform lifetime table is for. If you are age 73 or older and have traditional IRA or 401k or retirement plan accounts, and you are no longer working, if you're in an employer plan, if you're in an IRA over age 73, you have to take a required minimum distribution. And this is how you calculate it. So it's based on what the balance of your account was at the end of the year last year. So go back and look at your IRA, look at your 1231 account balance, and divide that by the life expectancy factor that is next to your age on the table. And that's how much you have to take out this year to meet your required minimum distribution. And again, next time, what I will talk about is what do we do with required minimum distributions? Sometimes that's just a regular part of your income stream. Sometimes you want to use it for charitable giving. Sometimes you don't need it at all. So what do we do when we have to take money out of our IRAs? Because what does that do? It raises our taxable income. So just really important to know what your required distribution is for the year, and so that you can incorporate that into your income planning for this year. So that is the key financial data card, the key financial data numbers for 2024. And I will stop talking now and send it over to Betsy to see if we have any questions from you guys out there.
Thank you so much for going through that so thoroughly. That was really great info.
Sure. My pleasure.
We have a few questions. So who is it that sets these numbers?
That's a good question. It is the IRS. They do set these numbers. So they look at data. They look at the data. Lots of different agencies, I believe, contribute to the data that's needed to decide what these limits need to be, what these levels need to be. But essentially, at the end of the day, it's the IRS that controls what the limits are.
Okay. When looking at the provisional income for Social Security and determining the tax rate, are the income brackets structured as an income cliff, or are they progressive tax rates like normal federal tax brackets?
Good question. They're marginal. So they are like ordinary tax brackets in that first bracket, you're going to pay 0. That next bracket, you're going to pay 50, and the next bracket is up to 85% tax.
No, okay. Very good. So do these numbers traditionally increase year over year, or have we ever seen them decrease from one year to another?
I personally don't recall a decrease.
Okay.
Don't know that for sure. I'd need to go back and kind of look at things. Typically they increase with inflation. What the Secure Act has done is has added in some provisions that make it, like I mentioned with IRAs, where they will get an automatic increase based on inflation numbers, where that hasn't been that in the past. So there can be long stretches of time where the numbers don't change the numbers. And it could be for a variety of reasons. Like I said, when they're compiling all the information that's needed from the different agencies and whatnot to figure out how the numbers need to increase. Coverdell, good example of that one hasn't increased in a long time. And it just isn't, I guess it's not necessarily pertinent to increase it, or super, super important. Whereas, other numbers like IRA, if we're encouraging people to save for their retirements, then we need to increase the numbers as pay structures increase.
Right. That makes sense. At what point this year will we know how these numbers look for the 2024 tax year?
So these numbers are for 2024.
Oh, these are for 2024. Okay.
They are.
They have the following year, I guess, is what they're saying, maybe for the.
Yeah. Yes. So October is about the time when the numbers start to flesh themselves out for 2025. Social Security Administration, for example, they make the determination on their numbers in October. So, and that's why for any of you who may be on Social Security, or if you're not, usually towards the end of the year, if you're getting your Social Security benefit, you get a letter that is a determination letter that says, here's what your benefit will be next year. And that's why I mentioned sometimes your letter says that your benefit's going down, that what you're actually going to receive went down. And it's, if you look at the fine print, if you will, your benefit may have gone up, but your Medicare premium may have also gone up. So that is going to offset more. And that would be why the amount that you would get net would go down. But generally, to answer the question, October is when Social Security sets their numbers. And then November, unless Congress makes changes towards the end of the year, which, I mean, obviously, we do normally see lots of things happening at the end of the year and pushing it till 12/31 before there are some finalized numbers. But usually that's on really specific things or legislation that's out there that's just waiting to be passed. And also a lot of times when that happens, like we're seeing now with Secure Act, we see those deadlines get pushed because administratively it's just not feasible to pass something on 12/31 that needs to be rolled out January 1. So we often see a lot of push on when those numbers actually become effective.
That makes sense. That is similar to our last question. Will the election affect these numbers at all?
Well, won't affect these numbers for this year. So no to these numbers. Will it affect numbers in the future? Possibly. And I say possibly because we're looking at the Tax Cuts and Jobs Act, which is the tax legislation we're under right now, the tax code. That this tax code sunsets in 2025. And whoever the administration is at the time will have a lot of sway, of course, or whatever Congress looks like is going to determine what happens then. Do we extend the same tax code? Do we make revisions? Do we think that tax rates are going to stay the same, or do we think they're going to go up? I mean, given everything that's happened in the world since the Tax Cuts and Jobs Act was passed in 2018 and then became effective, everyone is going to have their own opinion on what they think about where the tax rates are going, but we're in one of the lowest tax structures in American history right now. And so I would be very surprised if tax rates go down. I'm crossing my fingers for staying the same. But I anticipate, if nothing else, being the planner that I am and wanting to make sure that I think through all of the, all of the options for my clients, I would anticipate rates going up. So that's a really great question. Your vote matters. Pay attention to candidates as far as what their feelings are, what their platform is for all of these numbers for tax rates and tax code, because it will be under the new president's administration that we know what the next tax code will be.
Very good. Well, those are all our questions today. And if anyone has any follow-up questions later, please email them to marketing@elevate-wealth.com. And then if you'd like to receive an actual physical card we are happy to mail you one. I did put that link to the PDF in the chat box, and I will also email it out to everybody who registered. And I'll also put it in the notes for the YouTube video once that rolls out. But if you want an actual cardstock card, we can get that to you. We're happy to do that. So just send me your address at marketing@elevate-wealth.com. And then go to our website when you can and sign up for our future webinars. Deanne mentioned that she's going to be doing another tax planning webinar in February. So it's always the third Tuesday of the month. So put it on your calendar. You can see our entire list of all our upcoming webinars on our website. And then be sure to check out our YouTube channel. Go to youtube.com and look for Elevate Wealth Advisory in Athens, Georgia. And you can see all our webinars we've done so far. And you can also see our weekly series, Elevate Wealth. It formerly was called WealthWise. And we roll that out every single week. You'll see a brand new set this year. We're attacking things a little bit differently. And you'll, I think, really be happy with the way that we're answering questions from our clients this year. So if you have questions you want Deanne to answer on the series or any of our advisors on the series, please send them over to us. We'd love to get your input. Well, thanks as always. Thank you, Deanne, for all your information. And we'll see you all next month.
Thank you, Betsy. Bye-bye, everybody.
Bye.